Alright guys, welcome to my extremely low production version of money. What I'm going to show you is really basic, but it's a really fundamental thing that you should really base not just your investments, but your personal finance on being able to build wealth over time to where you come out of life better than you came into it, right? Right here is the S&P 500 index. It's an index of the top 500 companies in the United States. You know, you look at it from all the way back to even this weird dashy thing, back to 1872. All right, it looks like it goes up, right? It has these, shitty times, right? Little shitty times, but over time it goes up. You're like, wow, look at that. It's a huge amount. You know, before the dot-com bubble, look at this. Let's go 1995. You're looking at $500 per share of the S&P 500. Today it's at $4,000. It's a pretty significant increase of money. You know, you think, dang, if I bought, let's say I was born 1997. So it's like my damn birthday, 1997. It was $537. Say my parents put $1,000 into it, I'd have like almost 5xing that money. But is it really the same? Am I going to really get 5x my purchasing power? And the answer is no. Because you don't need to look at the S&P 500 against the US dollar. What you need to look at in all of your investments is against the money supply. So this is the S&P 500 index against the M2 money supply. It's a supply rate. It's given by the Federal Reserve. Kind of counts all the money that's like all the US dollars that's in existence. You look at that same time period. Say on my birthday, they put $1,000 into my say they put $1,000 into a fund for me. That same purchasing power, so you're looking at let's do it right here, like 0.22. I would actually lose purchasing power right now from where we're at. Actual wealth that was produced from the S&P 500, even at the top of this huge rally we had post-COVID, right? I'd still be in the red. Why is that? Well, this is the actual M2 money supply by itself. All the way back to 81 and even before then, they print money at around 2.5% inflation rate. So every year, pretty much your savings account, whatever you have savings in dollars, is decreasing in value at 2.5% year over year. And that's in good situations like this, little run here. Nice, clean, like 2.5% year over year. Well, in COVID, the Federal Reserve decided it was a good idea to print out money literally for free, 0 interest rates. So it shot up a retard amount within, let's see, from February of 2020 to now. So, a little over 2 years, we've just about doubled, almost doubled the money supply within a 2-year time frame. So now you're seeing the price of everything going up. You first saw that in the S&P 500. It almost lines up pretty damn well to the printing out of money. This huge, nice, bull run. It was because the Federal Reserve was literally dumping trillions of dollars into the banks. And the banks know, as anybody else does, you print a lot of money, the price of everything's going up, the value of the dollar's going down. So they had to increase their risk by investing in the stock market, which led to this huge bull run. They're just trying to get away from inflation. Now, forget stocks and all of that. Let's look at your bank account. Like, you keep money in your bank, right? You're a good little citizen. You save money up. Well, shit. You lost a huge amount of wealth in your bank account in the past 2 years because of that printing of the money supply. So look at the M2 money supply every once in a while. See where it's at and ask yourself, is the things I'm buying going to appreciate at least as much as the inflation rate is going to be, and preferably more, right? You want to be able to invest higher than that. Always look at the money supply. If you ever get a TradingView account, it's free. Look at whatever you want to get into, gold, Legos, whatever, and see, does it appreciate more than the money supply does? So pretty much always value things against the money supply. That's all I got for you.